Welcome to IBG TV. I'm your host, Mike Hill. When it comes to dealership regulatory compliance, not knowing what you don't know is a nightmare waiting to happen. Laws, regulations, policies, procedures, training, auditing, regulatory compliance is complex, and it's a continuous mandated process. With me today is Mike Tuno, the president of ARMED.
Well, as I mentioned before, with me today is Mike Tuno, the president of ARMED. And welcome, Mike.
Thank you. Good to be here.
Well, thank you for coming. And what I want you to do, first of all, if you would, Mike, just give us a little bit of background on you, yourself,
Sure.
and ARMED.
Great. Love to. ARMED is the newest baby that was born about 6 years ago in my entrepreneurial spirit of building businesses. This was kind of the newest one built. What does that mean? Well, my background has a great focus for this subject because I started my career almost 40 years ago in retail with a big dealer group here in the Philadelphia area, and enjoyed selling cars, enjoyed doing F&I, enjoyed the retail environment. Decided to go back and get an MBA while I was still in the car business. A little tough to do that, trying to do it on the weekends and your night off or day off. And then I decided that perhaps that next level of engagement for me on a career and professionalism is I migrated over to the banking side of the auto business. I worked for a big lender in Philadelphia that was probably one of the bigger independent leasing providers back in the 90s, and cut my teeth there. Really cut my teeth there because they were on an acquisition mode of buying banks, which is frankly still going on today, right? They're consolidating. And they quickly identified some skill sets I had of bringing this business in from a variety of different lenders in the mid-Atlantic area to get their house in order, which meant audits. And so the bank internal auditors quickly took a liking to me, put me on the short list to kind of get everybody on the same page as they were folding in portfolios across the banking platforms. So there's some of the early foundation work that you can see that's starting to bubble up. Little did we know where we would be today, right? That long ago. From there, I left to go to work for a big global insurance company. I spent 10 years there. They're based in the Midwest. Rose very quickly through the ranks over that 10-year period of time to be kind of their golden boy. Bumped up against Y2K. I was their superhero to go out and solve whatever problems that we knew Y2K was going to create or wasn't going to create. And then they decided, the company decided that they really wanted to get a foothold in with the NADA. So I took on a role as a leader to compete for the business at the NADA Dealer Candidate Academy. I pushed out a 15-year relationship with another big provider in the US and held on to that relationship for 16 years. Pre-corporate or, corporate and then post-corporate. I decided in the early part of the new century here that I wasn't going to work for anybody else. So I started my own agency. So having the retail experience, a banking experience, the MBA, another master's degree in administration from Kellogg, I decided that maybe this was time to kind of spread my entrepreneurial wings. Started an agency, really began to do the heavy lifting on compliance, the old-fashioned way, pencil and paper. And over the last 20 years that the agency has been around, it got more and more difficult to keep up. So, I decided the only way I was going to keep up with this ever-growing legal landscape was to throw technology at it. So ARMED really was born out of all of that work and passion that started 40 years ago. So I'm a car guy. I mean, I've been in the car business my entire life. Love the automobile business. We're very dealer friendly. They're our friends. We want to make sure that we give them every opportunity to be successful in making money, and now with ARM keeping themselves safe from the big 800-pound gorilla that got born after the last recession, the CFPB. So we modeled our business after the outline that the CFPB wanted to see in our space called a compliance management system. And that really is the essence of ARM. It has four major components: policies and procedures, training, auditing, and a customer complaint module, all of which extend themselves into the dealership, fixed and variable operations, and they're role specific. So that when someone in service is getting dialed into their obligations in the compliance space, it's unique to that person or their role. If F&I is, then F&I is getting their piece of the pie as well. And it really gives the dealer one place to go to manage all of it so that they have a firm footing as these laws keep getting more and more and more difficult for dealers to embrace and understand.
Well, as you know, I absolutely love your training, and I've been through all of the courses that you have, and I'm looking forward every time you have an update and a new course that's going to be brought in, and constantly updating. Let's go into one area, and obviously it's an area that IBG is. We train and we coach all of our F&I managers along with the dealerships. Let's get into F&I compliance. What are some of the things that you see, some big concerns that a dealer and, more importantly, the F&I manager need to be concerned with these days?
Well, great question. We've all been through some challenging times here in the last year or two in our industry, and we're still battling some of those challenges today. What I see as kind of smoke on the horizon or trouble brewing ahead of us here, that's here now, but going to get more and more difficult for the F&I department, and in turn, obviously, the dealer, is this notion that what the federal government, mostly through the CFPB and the Federal Trade Commission, have been standing on their balls of their feet and leaning forward into the Equal Credit Opportunity Act and fair credit. This notion that bubbled up a couple of years ago that the NADA stepped into, called disparate impact. And what that change in the horizon has materialized to become is it's moved from the federal side pushing forward on the balls of their feet to the state side. So the state attorney generals have really taken this concept of fair credit and equal credit, and this notion of disparate impact, which is this theory that you either intentionally or unintentionally discriminate against protected classes in two camps. Your rate markup, which is where it started, actually here in Philadelphia with two Ford dealers, Pacifico and Springfield Ford, in 2007. The DOJ, Department of Justice, identified them at that time as having business practices that charged protected classes more in their interest rate markup. And so the NADA put out, under their leadership, a formula, a platform for helping the dealer body manage that risk so that they don't start with payments at the desk and then ultimately wind up in F&I. And the sales managers and the F&I managers or salespeople, however the store works, are all quoting from different hymnals or different rate guides or different markups based on their credit quality. So there's got to be uniformity. And the uniformity that needs to be in place really is the dealership's credit policy. That's critical to the success of avoiding intentionally or unintentionally adversely affecting in the interest rate spectrum of markup where dealers make an income, prejudicing protected classes. So we're seeing more of that now starting to traverse the state level. The state attorney generals have an association called NAGS, National Association of Attorney Generals. I don't know if that's an appropriate name, but it sounds like it. And so this change was recently identified in the state of New York. New York's a tough state to do business in for dealers, for lenders, for product providers, TPAs, because they're fairly regulated in what they want to do in terms of, not that any other state isn't, protecting the consumer. So this year, two lenders were dragged into a legal mess by the state attorney general in New York. One left the state, and one decided they're only going to pay flats now. In our business, when you pay flats, we know the nature of the beast, right? Which is that money's going to gravitate where they can make the most money. So that bank's already at a disadvantage, right? And so they fined one of the banks $275,000 and the other one $375,000, and one left. They're not doing business there anymore. So why am I bringing that up? Because this notion in the F&I office that the F&I department, in concert with the sales department, has identified a credit policy as per the NADA guidelines. What are we going to mark up each credit tier? And then when we deviate down from that, what's the valid business reason that we're giving why we did the reduction in credit? Okay. So we're seeing that. We're seeing that now getting enforced, not at the federal level, but also at the state level. So both confluences make it tough for dealers. Listen, the last year and a half, 2 years, it's been hard on state government. They spent a lot of money trying to fight the pandemic, trying to keep their labor force in place, trying to pay unemployment with little tax revenue or less tax revenue coming in. This starts to become an easy cash run for the state attorney general. The second area that we're seeing that kind of mirrors that is on the product pricing. So products that we sell in the F&I department really should follow the same format. The store should identify a maximum markup, and when they deviate down from that maximum markup, the valid business reason, so that they will always have documentation in their deal jacket or in the store for each customer when the banks come knocking on the door or the regulators come knocking on the door as to why they've discriminated against protected classes. You know, it's interesting. On the rate side, they use something called a proxy method. So they identify a zip code. They know the demographics of that zip code. And by definition, then they identify that as an area where protected classes may live. And so if we see a lot of that zip code coming up that might have protected classes, 50% of the population, they're going to call you out on it. And they're going to look for that documentation. So a good preventative measure for dealers, this has been around for a few years, get on board, get your credit policy, make sure everybody's on the same page with that credit policy. And when you deviate down on rate, make sure you document the valid business reason using the NADA model. It's all out there. We support it. We endorse it. We think it's a great solution for dealers to just be transparent. And the second one is on product. They had NADA released a voluntary product pricing, and I would use the word voluntary very loosely. Again, the states are coming after them for the same reasons. Are we charging protected classes more for interest rate loans? And are we charging them more for the products that they're buying? So let's get that at least on the table to identify a framework from which we can then say, this is our maximum retail for products. And when we deviate down, there's a valid business reason. Those valid business reasons have been around for a few years. Things like the customer's budget, competitive pressures from a dealership down the road, all the things that make sense, right? Not that we just willy-nilly decided that we're going to take advantage of one group versus the next. So those would be two very important legal matters surrounding equal credit and fair credit that have easy solutions for dealers to follow in the F&I office that keeps them out of harm's way. One thing I want to mention in addition to that is this notion, so talking about trends, and we're going to, what are we seeing? So we're seeing the federal government's statutes and their push forward really start to take shape at the state level. What we're also seeing is one other very concerning trend, and that is holding people personally liable outside the corporation for their behavior.
Go talk a little bit about that,
Sure.
Michael.
So in Philadelphia, where we're the city of brotherly love, there was a recent effort by the legal community to pursue National Auto Finance. National Auto Finance is a company that follows up customers, and I'm sure most of us have gotten these, to buy an extended warranty for your car or the one that's soon to expire. Right? Has a bad taste in a lot of people's mouth. Unfortunately, there are good programs out there. Unfortunately, a couple of bad apples have soured that pond, and so the plaintiff tried to pursue, because it's annoying, right? You're getting a call at night, you're ready to sit down and have dinner, so it just agitates the consumer. And so the plaintiff tried to go after the owner of that company personally, took it to court and tried to not only tie the corporation into violating the Telecommunications Act, right? Do Not Call Act, but also to drag him in personally. So I say that because dealers need to be mindful of this, that this shift in the federal laws dropping down into the state level, but also taking on a whole new dimension of trying to go after a corporation. The reason most corporations are formed is to give them protection, the veil of the corporation to protect you from a personal liability, right? And here they're trying to pierce that veil. So again, it probably won't be the last one, but it was certainly notable. It's certainly something that we should be mindful of as we all move forward in the F&I department.
Mike, in our IBG F&I boot camps that we hold every single month, we're always talking, and we go over and over full disclosure, full disclosure, full
Yes.
disclosure. What do you see are some of the traps or things that F&I managers may not think they're breaking the law when in fact they are in huge violation?
Great question. What we see, and it's the easiest fix, the use of menus is really, that comes up often. Is there a law about menus? No. Menus really are your tool for disclosure, right? And so it gives us documentation that we offered what we offered, and the good ones will document it with a time and a date stamp, and keep it very easy to provide transparency to the consumer about what's going on in the transaction. The one thing that we see still almost 20 years after the fact is Regulation Z was changed. It was amended. I didn't say it was changed. It was amended in 2003. Every bank contract that gets produced in the F&I office has two sections of the contract, about 2/3 of the way down and about maybe all the way 7/8 of the way down, in bold letters, that require the F&I manager to do two simple things. And we see it missed all the time. So this notion of disclosure. One, it's this easy. That customer, before you transact with that retail installment contract, should be given a blank retail installment contract to review, read, and ask questions before we start down the path of, payments and signing the contract and delivering the car. That is written on every single contract produced in North America. It's missed all the time. And what I always wind up having to have is a basic conversation that says, listen, we're going to make it this simple. Before you start printing that contract, either digitally or in your impact printer, whichever way you're going these days, more on the electronic side for e-contracting, make sure your customer has had an opportunity before we start putting any numbers or anything on in a contract form for them to sign, that they have a blank copy to review. And frankly, if they want to take it home and read it, Give it to them. Let them take it home. My experience has taught me on this one of two items on that contract, that change or that amendment to Reg Z in 2003, and here we are almost 20 years later, right? Is that's an easy way for everybody in the dealership to say the same thing. Yeah, every time we prepare to deliver a car with a retail installment contract, we always give a blank copy to the customer to review. Now, most customers may not have a question, or they may say, I'm fine, but that doesn't mean you shouldn't do what's printed in bold on the contract that you should read. Often I say, most of the time, if you read the instructions, you'll get your answer, and it's there. So we see that myth. That's that's a layup. That one should be a no-brainer all day long. The second one is, once they sign it, they get a copy. You and I have been around long enough to know some of the stories, the war stories of yesteryear, when we'll mail you the contract or press hard, there's 5 copies and your payment changed, right? I kid you. But that second piece is, often they don't get a copy of the contract. Again, both of those are on the retail installment contract, every single one. And they're easy things to do. You just follow the instructions. And I'm often surprised that no one does the first one, which is, here's your blank contract. Please review it. Ask me any questions you have. And I'm even more surprised when they sign it that they don't leave with a copy of it.
You would think that would be just natural. Now, that first part, I would love to see the statistics on it, but I'll bet you it is a low statistic of the people that are actually given that blank copy to review. And yet it's the law.
It's printed right on the contract. Not something I made up. So again, I look at it and go, well, what's an easy solution to disclosure? That's a big one. That's an easy one.
When we take a look at the Reg Z disclosure, okay, what should be disclosed? What is the information that needs to be disclosed on that contract? I mean, it's huge. It is huge. Yeah.
So we want to be mindful. We want to be mindful of doing things in 2 formats. We want to make sure we're doing it in writing and orally, both, right? And again, that's on the contract in writing. So if an F&I manager isn't clear, it's reiterated there again. And so the simplest way I can summarize it, there's a truth in lending or a Reg Z disclosure box, kind of sits at the top. It's all bolded out. Here's what we do. Start at the top of the contract and come all the way down to the bottom, and then flip it over, because often this can work in F&I's favor, especially on leasing. When we flip that contract over, we have an opportunity to discuss wear and tear and normal maintenance. So there's some product offerings that might make sense to a leasing customer as well, right? So I'm just highlighting some of the language on these contracts that if we make the consumer aware of it and be fully transparent, it actually becomes a good selling tool to satisfy a customer's need. I mean, it's that simple. So we start at the top and we go to the bottom. What's surprising when we do that is we probably overkill, but that's okay. No one's ever chastised anybody we work with for erring on the side of conservatism on disclosure. It's quite the opposite. What do I mean by that? Well, I often find if you ask this question, it stumps me to find out the answers I often get are the lender, and it kind of gets into a little bit of some of the risk-based pricing and adverse action. Dealers aren't sure they're the lenders. They think that the lender is, XYZ bank. If you look at the top of the contract, whose name's on the top left?
The dealership.
Yeah. So those are some of the easy things to remember. I would always say you'll never put yourself in harm's way by over disclosing. Never. I think your customers value that. Embracing compliance, embracing the laws, the business laws that you're required to follow to run your business, and making those very clear and abundant to the consumer. They value it. They value it. They look at you with trust. transparency, honesty, and you'll come back to buy more cars. It's an easier sale for the dealer thereafter, and they'll bring their friends and family too. Why? Because they trust you. You look out for their best interests, and I think that F&I can be a pivotal part of that equation in making all those things resonate for the consumer.
Well, Mike, just these tidbits of information that you've just given us, that they are absolutely huge.
Oh,
and
good. I'm glad to hear.
I would love it if you would to come back in future episodes, because I'd love to talk about some other areas that you brought up, credit applications, privacy, all these different things that are huge in the finance office.
There's a lot to talk about.
Well, thank you so much for
knowledge
being
is
with us.
power. There you go.
Well, thank you so much for being with us today, Mike.
It's my pleasure. Thank you for having me.
All right. Thank you.
Thank you.
For more information about this subject, please email me at mhill@ibginc.com or just give me a call at 801-440-7839. Thanks for listening.